So good morning to you, Chris. Thanks again for making some time.
Thank you for having me. Uh,
I want to start off the conversation about performance standards. Every retirement plan, whether it's a defined benefit plan or a defined contribution plan, has an investment policy, and they apply. Typically, fiduciaries apply that investment policy statement to the oversight of investments. But according to you and others, there's actually more that goes into evaluating investments.
yeah, performance measurement is, one of the key cores, but it's under the hood a little bit. We have so much superficial, even consultants and plans are so looking at every investment from such a superficial, they never look under the hood, look under the numbers and the performance numbers, how they're calculated is so important. So the best standard of investment performance has been the SEC's mutual fund performance standards. And so those are one of the few standards that I trust out there in the marketplace, especially when we're dealing with litigation or if you're doing it as a fiduciary. My trust level in SEC registered mutual fund performance is, 10 times higher than it is for most of the other products that I'm seeing, not only in public plans, but in 401ks as well. And what the real issue is, a lot of this of moving away from SEC mutual funds is to move away from performance standards so you can manipulate performance and hide fees. And that's one of my basic trends here. And it all goes down to performance standards. But performance standards are also based on accounting standards. And, the SEC has certain standards before you can put something in an SEC mutual fund. You can't put instruments that people make up the value. They have to have real values that can be certified. So, in general, private equity is not allowed in SEC mutual funds. Private debt's not allowed in SEC registered mutual funds. Annuities are not allowed in SEC registered mutual funds, nor is crypto, because there is not the accounting basis that you can make a performance measurement underneath those assets. So all this is kind of rolling in together into a lot of these issues they were talking about, and no one wants to look under the hood of, if we're going to put all these assets in, how do we even know the performance is real? Do we care? How do we measure it? How do we do our job as a fiduciary?
Really good setup there. Thank you for that. Let me go back to a comment you made about the SEC. What makes those I don't know the others. I mean, you're a CFA charter holder, so I think there are some GIPS and other standards
Correct.
that have been created. But what makes the SEC standards above everyone else, in your opinion?
Because they have a set of rules that everyone has to follow, and they enforce the rules. And you're not allowed to make up performance numbers in an SC registered mutual fund. I mean, there's a little fudging here and there. They're not 100% perfect, but they're by far the most perfect thing we have. With the other ones, CFA GIPS, Global Investment Performance Standards, or what we call CFA GIPS, were developed maybe 40 years ago, and they work very well with traditional stock and bond portfolios. But they just have, again, because of the underlying accounting, they have a hard time with any of the alternatives as well. And CFA does not enforce its standards. It kind of gives you out a rule book of good rules in general to follow in performance measurement and performance standards, but there's no one actually enforcing it, no one doing the underlying evaluations of it, so that it is a generally a rule. But the rules are good. They show a lot of fee disclosure. Now, the private equity industry didn't even want to give the amount of transparency that the CFA GIPS required, so they created some of their own standards called ILPA. I forget what it stands for, but it's another type of standards. And then even many of the private equity funds don't even want to comply with ILPA. So you've got entire asset classes led by private equity, and the other alternatives have issues as well that refuse to meet any performance standards. So, how do we trust those performance numbers? And again, I'm handling that on a lot of different levels of litigation as a consultant for all these different asset classes. And so what we've seen is a big move away from SEC mutual funds into poorly state regulated collective investment trusts because they don't have the performance standards. So you can sneak, private equity, private credit, crypto, annuities into these poorly state regulated CITs to get around that and to, in my opinion, had a lot of fees for the industry.
So let's talk to the consultant. What you and I would, we're old school, so we used to call what we do, we call what we do consultants, but now they're retirement plan advisors. There's all different names. So let's talk about what retirement plan advisors should do. So they got their investment policy statement, right? And the investment policy statement's kind of a loose structure or framework that you use to evaluate asset classes in a plan. And each consulting firm or retirement plan advisory firm has their own research team. What should
Mm.
they be looking for? And those research teams, by the way, get performance loaded and they look at the different 135 versus the universe, right? So that's all out there. But what more should they be doing, or can they be
It's
doing?
hard. It's a philosophical issue. I mean, we're getting this dealing with most of the consulting firms are now owned by private equity or partnerships with private equity and have a vested conflict of interest in using their more liberal performance estimates. So there's such a conflict of interest out there at so many levels that as a fiduciary, I think that the important thing is this: SEC mutual funds can be trusted. Once we get out of there, we have to have more scrutiny and more due diligence on any asset that is not an SEC registered mutual fund. That's really the basic theme that I'd like to get through here, is that people can trust the performance on their SEC mutual funds, but we get beyond that, my level of trust is going down precipitously.
So are there things that policymakers and regulators can do to beef up the state regs? Because you're talking about collective investment trusts, insurance products, all regulated at the state level. So are there efforts underway to maybe beef up those standards? Because look, investment products change over time. We know that. You and I both know that. The audience knows that, right? So you have to adjust your standards and the way you do business over time.
Well, again, I'm too much looking at the political process. All the money wants you to loosen the standards. Crypto's throwing all kinds of money in Washington. Insurance industry always has. Private equity has. So every pressure has been to loosen the standards. And again, that's what's happening, I think, at the DOL now. They're loosening the standards to allow more private things into the 401k plans. So I think all the momentum is toward loosening standards. But again, I think that a lot of that's going to end up showing up in litigation. The problem is that litigation only covers like the top 1% of plans. The rest of the plans all pretty much are on their own. I mean, I just did a piece on that where there are like 700,000 401k plans out there. There are only 7,000, 1% or over 100 million, which is kind of what the ones that would be litigated. That's still a lot to be litigated, have not been litigated yet, but we're working our way, maybe the top 700 of those 7,000 have been litigated, but the rest of the universe is kind of just up in the air, relying on regulators, and the regulators have pretty much ignored performance standards. I don't even know if anyone at DOL even knows what a performance standard is. That's how low the level of expertise is at at that agency. While the SEC does have a historic norm, they know they know how performance measurement works. They have a system that's been put together over 40 years that works, and everybody wants to get out of that system because it does work. And so that's kind of my get back to the theme, is that it's really the SEC registered mutual fund is a much more important product and valuable product than anyone realizes, because it does have
Mhm.
real performance standards.
So Chris, it sounds like everything falls again to the fiduciary, the plan sponsor. They're the ones that pick the attorney, they pick the investment advisor, and ultimately, Chris, they're the ones responsible for the plan. So, is there something that needs to be changed in terms of the vetting process for some of your partners, that sit around the table as a fiduciary?
Yeah, I mean, I think that you just have to realize you need 10 times the scrutiny in a non SEC registered mutual fund product than you do for an SEC registered mutual fund. and
Mhm.
investment policies, the whole industry is not catching up on that, and that's the gap. And you know, so for a fiduciary, it's much easier just to use an SEC registered mutual fund. You take your level of fiduciary risk is going down, 1/10 when you use SEC registered mutual funds. When you start using the other things, your risk just goes off the charts, and the only people making any money are are the industry. So that's kind of, and if you're a advisor, same thing. I mean, why not? Why get away from mutual funds when they're they're a proven easy thing to do? And if you're going to get litigated, we know in a mutual fund the litigation risk was you'd had a higher share class thing. If you're in with the mutual fund, all you have to do is be in the lowest share class you can be, and you're pretty much litigation proof. I
Right.
mean, I won't say proof. I mean, people are still, there's some dumb litigation out there around performance and target date funds, especially. But in general, that is the way to go, is to stick with SEC registered mutual funds.
Well, I guess we're going to have to see kind of where this shakes out. I mean, I guess TBD, right? Because this is an ongoing, as a consultant, my job was always to get underneath the hood, peel back the onion, whatever analogy you wanted to use, Chris, to explain to the client all the differences between the products that they were considering. That takes time, that takes a lot of effort, and it takes a lot of expertise and experience. I guess we're going to have to see if the firms step up to do that.
Well, they have every incentive not to. I mean, you could have four different consultants do an analysis of the performance of the same private equity partnership and come up with four very different returns.
Sure.
Ludo Filippo, who's a professor at Oxford, just came out with a piece where he showed that the big four private equity companies, Apollo, KKR, Blackstone, the performance he calculated was one half of the performance that they advertised and the consultants were using with their clients. So that is a pretty big risk out there to take because of poor performance measurement standards. So again, private equity has got itself, many consultants are now owned by private equity firms, or they have their own private equity products that they're making money off of. So there's so much conflicts of interest out there. There's the conflicting things going on there. But as a fiduciary, especially on a plan, be very careful anytime you're getting outside the norm. If it's a mutual fund, SEC registered mutual fund, if you're in a big public pension plan, you kind of, maybe a GIPS certified investment performance, CFA GIPS is the appropriate performance measurement for you.
Well said. Maybe a little bit this conversation, Chris, probably a little bit too more detailed than many are probably used to. But hey, look, if you're in a retirement plan, a pension plan, or you just want to understand the basics, you got to come to BRN. Chris, great to see you as always. Thanks for joining us. Great writing, great advocacy, and we look forward to having you back on the program again very soon, sir.
Thank you very much, Ed.
Well, thanks for watching, and don't forget, we're back again tomorrow morning with another great expert and another great topic. You can tune in right here Monday through Sunday at 7:30 a.m. Eastern Time. And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place, delivered directly to your email box. Check it out at our website.